In the real estate session, we discussed the changes that BEPS is making to the real estate investment world. The changes impact both investors and their returns on the investment, but also the managers. The profound changes that will take place here over the next few years mean that both investors and investment managers need to change their structures and adapt to the future. We also discussed the emergence of REIT regimes in more and more jurisdictions, and that the fact that these may ultimately create a type of state-condoned tax planning, in that it is what the states are trying to achieve at a moderate level of taxation for investors. Finally, we discussed the impact that the combination of these two factors can have on the value of real estate, and in particular, the impact that, first of all, at a commercial level, separating real estate from operating companies can have, but then in addition, the effect that the tax leverage that a REIT would give on a split could also have on the valuation of an enterprise. Welcome. This morning we'll be talking with the panel and hopefully with the members of the audience about real estate taxation and the changes that it's currently undergoing. At the same time as BEPS was coming along and changing the taxation of what we'll call traditional real estate fund structures, there has been a continuing rise of REIT regimes. And REIT regimes, to some extent, you can look at as state-condoned tax planning, because they're basically regimes that states themselves have said you can have a favorable tax rate on real estate income provided you follow certain rules. BEPS is just a symptom of what's been going on ever since the start of the financial crisis, which is that states are short of money. They've realized that a lot of the profits that companies make are highly mobile. They can be shifted around the world at a few mouse clicks, and we heard about this in some of the sessions earlier on. And one thing that doesn't move and can't move is real estate. So it's a rare commodity for tax authorities. It's something that can't be moved. So if you were to summarize some of the things that can be done in the short term, so the first challenge is interest deductions are going to be severely limited as time goes on.
Is really something that could be totally different, whether you are a totally opportunistic investor with a short window in terms of investment, let's say 3, 4, 5 years maximum, or whether you are long-term and very core. I would say that very core investors would most of the time take all the digits. They will put all the tax to see whether this works or not. In a way, it is also because I would say the model is less dependent on the tax because you spread over the time all your taxation, whereas more opportunistic players tends to be opportunistic in all the directions, including the tax one. So,
okay, let's move on to REITs then.
So I'm just going to spend a few minutes looking at what is happening in UK REIT world and showing how REITs, which were originally big listed companies, we're now beginning to see joint ventures and clubs of investors using this regime, and it has changed quite a bit. I think that's particularly come to people's attention recently when Broadgate, which is the largest complex of offices in the City of London, was put into a REIT by its current owners, which are British Land, 50%, that's our second biggest REIT, and GIC, the Government of Singapore Investment Corporation, the other 50%. And they've now made that into a REIT, and that's pointed up the opportunities which perhaps hadn't been obvious to a lot of people until recently.
Try to move through the U.S. REIT information quickly so we can cover the spin-offs and the value, which I think is very important. Obviously we have the most developed REIT taxation system, I would say. It's been around for decades. The rules are strikingly similar to what Charles described in the UK in terms of percentages of income that have to be distributed, the type of income that you have to be generating. So I'm going to move through that quickly. I just listed some of the other specific tests in here that you have to comply with. And the only thing I would note is many of these, including the top two, these securities tests, These are more diligence items, and when I say that, I mean, you know, the IRS is probably not going to come in and audit you and find that you violated a 10% securities test.
That's what I really wanted to kind of conclude on as a kind of as a final note. So if we look at what's happening today, real estate taxation is really changing. BEPS will impact many of the existing models. Then on the other side, we have all these REIT type models coming in, whether they're pure REITs, traditional REITs listed on stock exchanges, or fund type vehicles, as François was describing, or private REITs in the US. This may become the new normal for real estate investment because, again, it's kind of state condoned tax planning, and rightly or wrongly, the states feel they have better control over it. They've given this regime knowingly. They have some control over what tax they recover on withholding tax. Now, as we saw as in the cases François was outlining, sometimes they misunderstand slightly the tax they can actually take. But however, it is attractive for states as well. And then ultimately, as we think that as the market stabilizes and this becomes more clear and more common, we may see more and more of these splits of operating and real estate business, still driven by the commercial dynamics clearly, because that's the biggest part of it. But we may also see more and more that this tax dynamic comes in where investors say, if you can get us REIT type income streams at a low effective tax rate, then for us that becomes a very attractive proposition.